How can futures contracts hedge your commodity investments? Imagine you're a farmer about to harvest wheat in a few months. You worry that prices might drop before you sell. Or maybe you're a manufacturer concerned about rising costs for raw materials. How can you protect yourself from these price swings? That's where futures contracts come into play. They are a key tool for managing risk in commodity investments. Futures contracts are agreements to buy or sell a specific amount of a commodity at a fixed price on a set future date. These contracts are standardized, meaning they have specific sizes and delivery dates. For example, a wheat futures contract might cover 5,000 bushels and settle in 3 months. By locking in a price today, you can plan your finances with more certainty. If you're a producer like a farmer, you can sell futures contracts now to lock in a selling price for your wheat. This way, if market prices fall by harvest time, your losses are offset by gains from the futures position. Conversely, if you're a buyer or manufacturer, you can buy futures contracts now to secure input costs. If prices rise later, your futures position gains value, balancing out higher expenses. To hedge effectively, you take an opposite position in the futures market compared to your physical commodity. If you own the commodity, you sell futures. If you plan to buy it later, you buy futures now. This offsetting position reduces your exposure to price changes. There is something called basis risk, which is the difference between the spot price of the commodity and the futures price. While hedging reduces the risk of price swings, it doesn't eliminate basis risk entirely because spot and futures prices might not move perfectly together. Still, this risk is usually smaller than the outright price risk. Another important concept is the hedge ratio. This is the proportion of your physical commodity exposure that you hedge with futures. An optimal hedge ratio minimizes the overall variation in your combined position's value. It considers how closely futures prices track spot prices, which isn't always perfect. Using futures contracts for hedging helps you lock in prices, making your revenue or costs more predictable. For farmers, this means protecting against falling prices. For manufacturers or airlines, it means shielding against rising input costs. Investors and traders also use futures to hedge existing commodity holdings, reducing potential losses. In summary, futures contracts are a practical way to manage the risks tied to commodity price fluctuations. They allow you to stabilize cash flows, plan budgets more accurately, and protect your investments. Whether you're a producer, consumer, or trader, understanding how to hedge with futures can help you navigate volatile markets more confidently.